Okay, welcome to Business 100, Chapter 14. Um, this chapter is titled Accounting and Financial Statements. I'm going to have some videos up there that'll help you with the accounting the financial statements. But here we're looking at analysis. We're looking at ratio analysis. So we're going to go over the ratios. We're going to look at them, how to calculate them, and then we're going to do that for a couple of companies if we have time. Sears, which is doing really bad, and Apple, which is doing very good. So, very well. So here, liquidity ratios. The first one we've got. These are ratios that measure the speed with which a company can turn assets into cash to pay off short-term debt. These ratios here are very important. Cash is the lifeblood of a company. If you are making profits, but you're not turning those profits into cash, then you're not going to be able to pay your bills. A company has to pay their bills to stay as a going concern. So these liquidity ratios are very important. Also, if you're ever if you ever own a business and you're looking for a loan, first thing I always look for as a banker is I'm looking at these liquidity ratios, and the main one I cared about was the second one, the quick ratio, or what we called the asset test. So we're going to start here with the liquidity ratio, with these liquidity ratios. The first one is a current ratio. A current ratio is equal to current assets divided by current liabilities. Now these documents come from the company's financials. An easy way to look up financials for almost any company is you can go here to Yahoo Finance. So if you're thinking of investing in a publicly traded company, you can just search in here. Like I'm going to do Apple, AAPPL. Sorry, one L, P, Apple. Okay, and you can pull up Apple, and when you get there, you'll see this financials here. Okay, there's financial documents. You can see here. This is the income statement. You get a balance sheet and a cash flow from 9/30/2017, 9/24/2016. So these are yearly over the past 4 years, and we're not quite the income statement hasn't been posted yet for 2018. So, because it's just barely been due. So what we're going to do is I've got these things in a spreadsheet here, Apple's spreadsheet I'm calling it. And you can see here for year 2017, Apple had 229,234,000,000 in revenue. Now that's not what they get to keep, that's just revenue. The cost of that revenue, or cost of goods sold, say the iPhones, was 141,048,000,000. So their gross profit was $88,186,000,000. Okay. Now here for that current ratio, I'm going to look down here to their balance sheet. Okay. And if you look here is the balance sheet. Balance sheet always has assets, liabilities, then equity. So we're looking at assets, and we want current assets. The things that count as current assets are cash and cash equivalents. That's cash, say a bank account. Short-term investments, if you have stocks or bonds or money markets, those things count as short-term investments. Net receivables, that's money that's owed to you by your customers. So in this case, maybe Apple has sold some phones to AT&T and they haven't received the payment yet. They could go 30, 60, 90 days, something like that. They're always less than a year. And then we have inventory, which is a controversial one we'll talk about in a little bit. If we add these four things up and other current assets, that would give us total current assets of $128,645,000,000. Okay, those are things that Apple has that they can turn into, or very easy, or shortly, within usually less than a year, turn into cash. You take that number and you divide it by their current liabilities. Liabilities are things that you owe to other people. So if you look here, Current liabilities. We've got accounts payable. Those are usually accounts that you have to pay less than a year, usually to your suppliers. I've got short and current long-term, short, current, long-term debt. That is long-term debt that there's less than a year payoff on. Other current liabilities, and then I've got my total current liabilities, which were 100,814 million. So I took, where do we go here? Current liability, current assets is what I'm looking for. Total current assets, and we'll highlight that, divided by total current liabilities, we'll highlight that, and that becomes our current ratio. What this number means, 1.276, this means that Apple has roughly $1.27.6 in current assets, things that are easily or quasi-easily turned into cash, available for every dollar in current liabilities they have. That's a good number. That means they can pay their bills in the present. The next thing we've got is the acid test. And that's the one I used a lot as a banker. When I would go into an office, businessman's office, first thing I'm doing is I'm quizzing him. I'm getting his financials. I'm getting the information so I can do a quick acid test in my head. Does this business have enough things that they can easily turn into cash? Inventory is not easy to turn into cash, or at least it might not be. To give you a quick example, I used to bank a sporting goods company, and they had mostly clothing that was related. So like if you wanted to go hiking, they had hiking clothes. If you were a kayaker, they had kayaking clothes. They had shoes, all kinds of active wear, and then they had some sporting goods, but mostly just clothes. Now, I know nothing at all about kayaking. I've never been. So I don't know if this inventory they have, I don't know if it's easily convertible into cash. I don't know if it's in fashion, right? Maybe new kayaking clothes are coming out, better material, better design, something. I don't know how marketable this inventory is. So I throw that out. I take your current assets minus your inventory. Okay, so going back here to our Apple spreadsheet, when I go down here to the balance sheet, I'm not going to take total current assets anymore. That's not useful to me because they've got this inventory in here. I don't know if that's any good. So I take current assets, subtract inventory, and then I divide it by current liabilities. So we're going to create, just decide here, we're going to create a little spreadsheet here. And what I'm going to do is I'm going to take my current liability, total current assets, and I'm going to subtract inventory from it. Then I'm going to put it in brackets here. Okay, that right there is total current assets minus the inventory. I might also subtract other current assets if I don't know what they are. Okay, and I did that above. Then I'm going to divide that by total current liabilities like I did with the current test, and I'm going to get a number, and I got 1.2279. Okay, which is a little bit less, I believe, than I got with the no, it's wait. Okay, so 1.2279. So roughly, that tells me Apple has $1.22 in in these very quick assets per dollar of current debt. These guys can pay their bills. So now I can talk to you as a banker. Now I'm like, I'm interested, okay? You want to do some borrowing? You've got the money to pay the debt. Let's see what you can do. Most lenders are what we call cash flow lenders. This is what I'm looking for. First thing I'm looking for when I walk in is this acid test number. Okay, and these are a little bit lower because I subtracted out these other current assets here. I don't know what those are. If I knew what those are, I might add them back in and get a number like this. Okay, but I'm looking here, and Apple can pay their bills. They've got enough cash to pay their bills. Okay, so now I'm thinking about lending them money. Okay, the next thing we have are debt utilization ratios, and we're going to go back here, and we've got our debt utilization ratios. These are ratios that measure how much debt an organization is using relative to other sources of capital, such as owner's equity. I'm looking here, I'm like, how much are you borrowing? How much of your company is in debt? Because I can only lend you money against equity and cash flow. So I've got to know how much you owe to other people, how much of this company is really even yours and not a bank's or a bondholder's. So the first thing we're going to look at is something called debt to total asset ratio. The debt to total asset ratio is a ratio indicating how much of the firm is financed by debt and how much by owner's equity. So let's say you've got a company and there's $100 in assets, but you've borrowed $60, okay? The debt to total asset ratio would be the $60 in debt divided by the $100 in assets, and roughly 60% of that company, 0.6, is owned by the banks. 40% belongs to the owners, okay? Debt financing is riskier than equity. So if I'm thinking of lending you money and you have a high debt to equity, debt to asset ratio, I'm very concerned because that makes your business more risky. You've got more leverage, which when you get into, say, a more advanced finance class, you talk about leverage ratios, which continue on from this debt to total asset ratio. Okay, leverage tends to magnify profits and losses. So a company that has a high debt ratio is heavily leveraged. A small percentage profit on, say, their sales or equity turns into a big amount of profit. Excuse me, a small profit ratio turns into a big amount of profit in terms of equity, as long as they're paying their debt off. They're paying their debt payments. On the other hand, a small loss, a small percentage loss, gets magnified on these companies, because a small loss can wipe the whole company out, and that's because of leverage. Okay, so the more leverage you are, the more responsive profits and losses are. Most companies tend to keep debt to asset levels below 50%. This would be specific to certain industries. Some industries might not use a lot of debt at all. They may be well under 50. Some might use more. Large capital-intensive industries like a utility, say a power company, because they have to buy plants and all these other things and update them and refurbish them, they may have debt to asset ratios higher than 50%. Meanwhile, a small retailer may not. Okay, so here, when we calculate this, we're taking total debt divided by total assets. We get that off the balance sheet. So here for Apple, I've got my balance sheet. And what I'm going to do here is I'm going to look for total assets here, and I'm going to color that in red. Actually, we'll color that in, well, I can't use black, we'll use blue. I'm going to color that in blue. And then I'm going to divide total assets by the total liabilities this company has. And I'll highlight that one in red. Oops, all red here. There we go. We won't do that because now you can't see it. I'll have to make the lettering black. There we go. Okay. Okay. So we're going to take these total assets. That's going to go on the bottom. We're going to divide total liabilities by the total assets. So we're taking this $241,272,000,000 in total liabilities for Apple, and we're going to divide it by the $375,319 in assets that they own. And we go up here, and you can see their debt to asset ratio is above 50%. Then here, I've done it for the last 4 years, and you can see that their debt ratio has actually been going up. That is not a good sign for a company. Okay. Okay, so you can see here that over the last 4 years, debt to total assets has increased. Some of that could be, now just because it's increasing doesn't mean it's a bad thing. One explanation of this would be that Apple has been building plants in the U.S. and in fear of a trade war or whatever like that. So that could be an explanation. Hey, we've had to borrow more money to build more plants in America because we're worried that trade wars can break out between the U.S. and China. We make most of our stuff in China, so we want to have some plants over here. So those could be reasons for that. It's not necessarily bad. The next thing they have here is times interest earned. So times interest earned. Okay. Times interest earned ratio is operating income divided by interest expense. The times interest earned ratio is equal to operating income divided by interest expense. It is a measure of the safety margin a company has with respect to the interest payments it must make to its creditors. A low times interest earned ratio indicates that even a small decrease in earnings may lead the company into financial straits. In other words, they won't be able to pay their bills. So we look here for Apple, and we see that times interest earned. So we will go here to operating income or loss. Operating income or loss, that's on the income statement. And we divide that by interest expense here. And that's a negative, so we make it a positive. So we take that, divide it out, and that came to 26. Now, if you look here, that times interest expense for Apple is steadily going down. So that's something we might be very interested in, is why is your interest expense going up relative to your operating income? And if we look here, Apple's operating income has not been, it's gone up a little bit, but it's staying steady the last 3 years. It's not, dramatically increasing, while those interest expense is going up quite a bit. Okay. Some of that's because they're bringing on more debt, so that's going to increase the interest on their debt payments. The next thing we want to look at is profitability ratios. These are important. Profitability ratios are ratios that measure the amount of operating income or net income a firm is able to generate relative to its assets, owner's equity, and sales. Okay. This oftentimes will tell you how much pricing power a company has. Over time, if their profitability ratios are going down, that's an indication that maybe this market is becoming more competitive. And maybe the iPhones, if we're looking here at Apple, maybe more people are entering the iPhone market. The cell phone market. Cell phones are becoming more of a commodity rather than individual sales. There's a lot of competition in this market. So the first type of profitability ratio we're going to deal with is the profit margin. Net income divided by sales. The profit margin is equal to net income over sales. It shows the overall percentage profits earned by the company. The higher the profit margin, the better the cost controls within the company, and the higher the return on every dollar of revenue. So we sell $1 worth of stuff. How much do we get to keep in profit? Okay, So if we go to our spreadsheet for Apple, we're going to take net profit. So we're going to go to the income statement, net income from operations. And here we're going to divide that by total revenue or sales. One of the tricky things with these is some companies will call it sales, some will call it total revenue. This next thing here, cost of revenue is what Apple's calling it. A lot of times a retailer especially will call it cost of goods sold. So we bought $1 million worth of groceries at our cost, that's COGS, and we sold it for we were sold for $110,000. The operating profit or gross profit would be $10,000, actually gross profit. Then we take our operating expenses out, and that would give us our operating income or total operating income or loss. Then we take things out like interest payments. That would give us earnings before interest and taxes. Then we take out income, interest expense, income before taxes, income tax. That gives us income before taxes. I'm sorry. Then we take out income tax expense, minority interest which we don't have any, and then net income from continuing operations. That's going to be the net income. That's how much this company made in profits after it paid for everything it sold, after it paid for all its operating costs, and after it paid interest and other expenses. Okay, so here for net profit margin, we're going to take net profit, we're going to divide it by sales, and we got 0.2109. That's a 21% net profit margin, which is pretty darn good. That's a high net profit margin. That's an indication that there isn't a lot of competition with iPhones in the market. Now, if you look at the cell phone market as a whole, it's very competitive. But Apple has been able to establish a brand, and a lot of people are very loyal to that brand. I think we all know people who will only buy Apple, even though someone might say Samsung's better technology, more advanced, whatever. There's a lot of loyalty to Apple, so they're able to get good prices for their cell phones relative to other companies. And this is also could be an indication that they're doing a good job of controlling their costs. The next thing we have is return on assets, ROA. And if we look here, return on assets, there we go. Net income divided by assets. So here we took net income divided by sales for net profit margin or profit margin. Return on assets, you take net income and you divide it by the assets. Net income is on your income statement. We got that earlier. Total assets is on your balance sheet. So we look here. Total assets is in blue. So we're going to take 48,351,000,000, divide it by 375,319,000,000, and that's going to give us here 0.1288. That gives us an idea of how well of a job Apple is doing turning their assets into net income or profits. And they're doing that at about a 12.8%, 12.9% return on their assets. Another very, very good number. Okay. Finally, we have return on equity. This tells us how well the firm is using the investor's equity. And here you take net income divided by owner's equity, also called return on investment, ROI, but ROE is what most people call it. Return on equity shows how much income is generated for each $1 the owners have invested in the firm. Stockholders are always concerned with how much money they will make on their investment, and they frequently use the return on equity ratio as one of their key performance yardsticks. Okay, so return on equity is net income divided by owner's equity. So here we divided net income by assets, that's return on assets. Net profit margin, net income divided by sales. Now we're going to take net income and divide it by owner's equity. Going back here, We've got net income. Owner's equity is going to be down here at the bottom. Okay, total stockholder equity of $134,047,000,000. And when we took that out, we got this whopping 0.3607. So we read that as a percentage, roughly 36.1% with rounding, is the return the owners are getting on their equity in terms of net profits. So for every dollar they've invested in the company, they're making 36 cents on that every year in net profits. Now that's different from, say, a dividend, which we'll talk about later. But the equity in this company, for every dollar they have invested in, is earning them 36 cents. The next thing we're going to look at are asset utilization ratios. Okay. Here, these tell us how well a firm is using their assets. So this tells us how productive they are with assets and equity in terms of a return. Here, we're looking at how well these firms can turn assets, accounts receivable, and inventory into revenue, not profit, but revenue. So here, receivables turnover is equal to sales divided by accounts receivable. It indicates how many times a firm collects its accounts receivable in 1 year. Some firms can make their numbers look better by giving credit to poor customers, and that's risky. Okay, we're looking at how many times does this receivables that the firm has, how many times does it get turned over in a year? Borrowed, paid back, borrowed, paid back. So we go here, and for our receivables turnover, we're going to take sales, and we're going to divide it by accounts receivable, which is on our balance sheet. And that's 35,673,000,000. We divide sales by this, and that gives us a receivables turnover of 6.425, actually 6.426. So they're turning over their receivables roughly 6.43 times a year. We might compare that to previous years and say, whoa, look, that number has gone down, at least in the last 3 years, and it's the lowest it's been in the last 4. Maybe Apple is extending more credit to boost sales. And that could be a bad thing if they're extending credit to riskier customers, to firms that are maybe closer to bankruptcy or having problems and might not be able to pay that back if, say, the economy turns down. Excuse me, my throat is getting dry. The next thing we're going to look at, inventory turnover. Inventory turnover is sales divided by total inventory. It indicates how many times a firm sells and replaces its inventory over the course of a year. A high inventory turnover ratio may indicate great efficiency, but may also suggest the possibility of lost sales due to insufficient stock levels. So it's a good and a bad thing. A high turnover ratio means you're not paying a lot to store inventory. You're not producing extra units that are just sitting in a warehouse. You're flipping this warehouse over and over and over again. But it could also mean you're not carrying enough inventory, you're not producing enough, say, enough iPhones, and that you are losing out on profit opportunities or sales because you're out of the product. So we look here, our inventory turnover, we're going to take sales and we're going to divide it by inventory, which is on our balance sheet. Sales is on the income statement, inventory is on the balance sheet, and this number is very high. But if you look, it's been much higher in the past, and now it's going down. That could be a sign of two things. One, maybe sales for iPhones and other things that Apple sells are slowing, and they're not turning the inventory over enough, but 47 times is a lot. Or it could be an indication that they're increasing production, and maybe some of the sales they were losing out in the past, they're not. So we might want to look at revenues here over this time and see, have they dramatically gone up over the last year? And if you look here, it does not seem that sales total revenue is really increasing a lot as this inventory turnover number goes down. So that could be an indication that sales of some of these things are slowing relative to the number of units that they're producing, and they're forcing them to hold higher inventories. We look down here, that inventory number doubled over the last year. So that could be problems with the iPhone selling or other inventory that they keep. They might be having a problem selling some of it. Sales are slowing. The next thing we have is TATO, total asset turnover. That is a ratio that tells you how well we're using our assets to turn them into sales dollars. Okay, so you take sales divided by total assets. How many dollars in sales are we generating for each dollar we have in assets? So we go back here to our spreadsheet. We're going to take sales, and now we're going to divide it by the firm's total assets here in blue. And if you look here, that total asset turnover rate is 0.61. That, again, is a number that has been significantly going down for Apple. Are they having a problem using their assets to generate sales? This, to me, along with this inventory ratio and receivables turnover, here is not that indicative of it, but these two here give me an indication that maybe sales are slowing for these iPhones between 2016 and 2017. I'd really like to see the next report that comes out and find out if this trend continues. Then maybe as an analyst, I might say, I think there's a problem with Apple. Apple's slowing sales. Their debt is rising. Their current ratio has decreased over the last year, but it's higher than it has been in the past. So they look like they've got ample liquidity. Their debt ratios are a little unnerving. These are big changes, 136 to 26. And that's not being met by increased turnover. Or, as we've seen here, profitability margins aren't significantly higher. In fact, they're lower than in some years. That's an indication that there might be some problems with Apple. Now, I'm going to skip the per share data. You can read about that. I want to keep the video short. But this last part here, industry analysis. There's different types of ways you can use this data. One is we can examine trends in the ratios over an appropriate time period. That's what we kind of did later on here. We looked at what these ratios were doing over time, and that told us maybe Apple's position is weakening. Industry ratios are also useful. We could compare Apple to industry ratios to see how they compare. Is their turnover ratio high or low for the industry, even though it's going down? Okay, those are types of things we can look at. And then we could compare it to other firms to see, hey, are they experiencing the same trends? Are we competitive with them on these ratios? Exactly what's going on. Now, I'll tell you right now, one thing we know about all of this is Apple makes their money from high net profit margins. These are very high net profit margins that they're making on these goods. Okay, 21%. They're doing great on return on assets. These are very high returns. But there's indications of problems here with debt. I'm sorry, I went wrong row. With debt, their debt ratios are going up. Their times interest earned is going down. They're still more than high enough to cover their debt and the interest on it, but you can see significant deterioration in that number. That's something I'd want to look at. That and these decreasing asset utilization ratios. They're not using their receivables, their inventory, or their total assets as productively now as they have in the past. So those are things and how to look at it. Um, some short questions after this. I'm going to put this little word sheet up, save it for you, and it'll be available in the Chapter 14 folder for you to look at. I would know these things by heart. Write them down. Make sure you know the ratios, how to divide them, and what they tell you. Okay? Thank you very much. Have a great day. Bye-bye.